Hello, everyone. It's great to have you here for our conversation with Chris Meyer. Hello, Chris.
Hello, Tillman.
How are you today?
Excellent.
To give a start, I want to ask you for an introduction because you're the first time on the channel. It's great to have you here.
Mhm.
And I just want to ask you what's interesting that other investors should know about you and what makes a good investment for you as a beginning question.
All right. Well, let's see. About me, I started my career in corporate banking, and where I made loans to all kinds of businesses. That was an interesting place to start my career in finance because as a lender, you really think a lot about the downside and balance sheets, and you learn how to value different assets. So that was a very good training ground. Thinking about downside first. I did that for about 10 years, and I always liked to write, and my passion was always for the stock market. So I started a newsletter on my own in 2004 called Capital in Crisis, and that did well enough so that within 6 months I quit my banking job and did that full time. And I did that for about until about 2016. In 2016, I started working with the Bonner family office. The Bonner family owns Agora, a big publisher. They were a publisher of my newsletter. And so I started helping them with the family office. And then in the middle of 2018, I proposed to them the idea that maybe we could start a fund. And long story short, they seeded it with $25 million in capital, called it Woodlock House Family Capital. It's named after a property they own in Portlaw, Ireland. And we started the fund, opened its doors in 2019. And that's what I've been doing ever since, full time ever since. One good thing I always like to point out when I did the newsletter is I got to travel all around the world. I've been to 40 some odd different countries and wrote 4 different books and met all kinds of interesting people. So that was a really good time doing that. And then you asked what makes a good investment. Well, these days I'll say if I kind of drop the ideal, it would be a business that produces lots of free cash flow, has a long runway for growth. It generates a very high return on invested capital, has the ability to reinvest those profits and cash flow and earn consistently high returns on that investment. I'd have a good balance sheet. I'd have a very good insider, like a CEO who owns a lot of stock and is preferably on the young side, maybe 50s, 40s, 50s. And then I would sit back and watch it compound for years and years. That would be the ideal.
Sounds good.
Yeah.
Before we could go into details, I want to post a disclaimer. But before that, I want to ask you have this great bookshelf behind you.
Yeah.
I want you to grab a book that's a good investing book for you, if you have good investing books there, and a book that's a good non-investing books you can recommend. And
All right.
that, I will post a disclaimer so everybody can see the disclaimer and you can
I'll be right back.
Get the book. So guys, as promised, here's the disclaimer. You can find it also linked below the video and look at it. It just says, do your own research. We are having here a good conversation. We have knowledge, but it's always that you have to do your own research and we make no advice, just do your own research. Thanks. And now I'm curious about the books and to see what Chris found.
Okay. Well, yeah, behind me, I have several shelves of investing books.
Looks awesome, like an awesome bookshelf.
Yeah, some of them go back quite a ways to I think maybe the earliest I have some Peter Lynch books from 89, I think was his first one. So, and they're hardcover, so they go back quite a ways. And some of them are even older than that. So I picked 2. The first investment book is one that people have heard me talk about. It might be hard to get now, but it's a great read. And it's
Humble.
Sosnoff's, yeah, by Martin Sosnoff, Humble on Wall Street. And came out in 1975. He's a money manager, or he's been a money manager for, at that point, I think since the 60s. He managed, I forget. But anyway, he's a very good writer. So I enjoy this because he talks about a lot of experiences investing money. And one of the things I take from Sosnoff is he was one of the ones who really drilled into me the idea of how important it is to have an ownership that has skin in the game and that cares about, the business. So, I mean, this book is just really, really fun to read. And again, it might be hard to get now. But definitely like this book. I guess I'll read this little beginning for you. It says, as a state of mind, Wall Street is no different from Main Street. Lazy and avaricious, prejudiced and easy to panic, it can believe in anything and just as readily shed its belief. Its deeds and misdeeds are clothed in generic rhetoric of petty politicians, and its people are there only to make money. But anyway, he just writes really well. So I picked that one. And the other one I had to grab because it inspired me is, which you may know, is 100 to 1, Thomas Phelps' book. So again, this book, there are parts of it that don't, date that well, but it's the original study of 100 baggers and stocks that went, up 100 to 1. And that's also very well, he says it's also very well written. So there's a number of little quotable things in here. I remember saying things like, if not for thieves, there'd be no locks, talking about how problems create opportunities. So it's a fun read. I definitely recommend that one. Then for non-investing, I have a lot also on my shelf of, I have a lot of philosophy books, and some of my favorite thinkers be pretty quirky, like Buckminster Fuller and Alfred Korzybski. So I grabbed Korzybski, although I don't recommend anyone really start and read this. Science and Sanity. It's a very thick book. It's hard to read, but I think if you could read a little bit of general semantics, I think it would help your thinking. I think the way you think about general semantics, it's just another way to aid critical thinking. And actually, I wrote a book that applies general semantics to investing. It's called How Do You Know? So anyway, those are some things I pulled.
What did you learn from the transfer from semantics to investing?
Well, I learned, I came to appreciate more how language influences how we think, and the power of naming something. When you call something a name, how it can influence how people think about it. And so it comes up all the time. People call a stock a growth stock, or they call something a compounder, or they say it's a large cap or a mid cap, and they treat these entities as if they were real, and they had certain meaning to them. When you really break it down, a lot of these terms they're really arbitrary and not as useful. And so when you start seeing even something like when people talk about the economy, and you break that down, what does it really mean? What are they talking about? And so that's one thing I think is important, just to pay attention to language, and particularly how we use these abstractions, and we just sort of pass over them as if they were real things. And if you kind of break them down and examine them, you find there's not really much there.
It's interesting to take this idea with me. Thanks already to the viewers for the questions you've handed in. I already saw them, and I'm happy to receive more questions to Chris, because this day is all about the questions from the audience, and I already received a lot of questions. One I want to ask, also in the metaphor of the bookshelf you have behind you, to think about the current time we are in. We are in a big bookshelf somehow on the internet, and there's a lot of information, a lot of offers. And it's that with your time, you can only read one book at once. So the question is how you stay focused in this time. It's coming from Necker Cap. Best wishes to you.
Yeah, well, I'm pretty disciplined about always carving out time to read books, and carve some time to reflect on things that don't directly have to do with markets. So fact, just recently I read a biography of Montaigne, the French essayist in the 1500s. And there were some unexpected parallels with our own time that I didn't expect to find. So in the 1500s in France, where he was, there was the plague. And so he talks about how difficult it is to travel during the plague and all the different things people did. And it was interesting reading that again, because I didn't anticipate that, but it had obviously immediate impact that we're going through something, well, not like the plague, but we have our own pandemic, and makes you think that humanity's been through worse things. And as bad as the pandemic is, it's certainly not the plague, and we're in much better shape than he was. But I always carve off some time, and usually that time is at night, to try to read things that just I'm interested in, carve out time for biographies or books on philosophy or other topics like that. And the other important part about staying focused is you have to really be good at managing your time, even on social media. I mean, I'm on Twitter, but Twitter can be a huge time sink, if you let it. You could spend an hour on Twitter, and then you get to the end of the hour and you're not really sure what you were doing that whole time, what you really take away. It's like junk food, just kind of. So I try to manage those times as well. There's certain times I like to do it, and then otherwise I stay away from it. And also managing your news feed. I mean, there's some things I like to read in the beginning of the day. I always read the Journal, the Financial Times, but there's just so much that you could read, and it becomes really important to carve off time so you're not just being a news junkie all the time. It's important to leave time not only to read those books like I mentioned tonight, but also to just spend time with primary documents, spending time reading annual reports or going through investor presentations and transcripts. And those are the things that you usually get a good bang for your time there. So you just have to, it really requires you to manage your time well and not allow the distractions to take over.
So how do you select what you read in this nightly reading?
Yeah, well, the nightly reading is always just sort of whatever grabs my interest. So I'm interested in a lot of different things. And like I told you, I read Montaigne's biography. I think I have been on a little bit of a biography kick. I read a recent biography on Søren Kierkegaard recently. So again, it doesn't really have to do anything to do with markets. It's just interesting people and what they've done. I like reading about philosophers or writers and different time periods in their life experiences. So really, it's just allowing me to just follow my interests, not necessarily, I'm not looking for a payoff or some key market insight all the time. Just allow some time to reflect on other things.
It's interesting. There's one quote where you make the metaphor of a hunt for 100 beggars. So what are your ways if you're hunting? How are you coming closer to the deer or to the target?
Yeah.
To use this metaphor.
Yeah. Well, there are certain ingredients that are important, and sometimes I think if I had to do the book again, I would emphasize more than perhaps I did that the key ingredients are really, you have to have that high return on capital. You have to have a business that generates high return. It's very difficult to do it otherwise. Now you could, there are always exceptions. So there are lots of companies where it would have been very hard to discover that they would have been 100 baggers because they either didn't make money for a long period of time or whatever. But the ones where you have a better chance of perhaps identifying earlier are those ones where the economics of the business themselves are great. So you could, if you looked at the early days of McDonald's or Starbucks, you could see that the underlying store economics were always very good. And so their returns on capital are high, and then they have the ability to take that profits and reinvest it again. That's where you really get that compounding. In the real world, it's hard to find companies that can do that. Most of the time they're paying a dividend, or there's some leak. They're not investing 100%. They're reinvesting maybe half or even 30% or even less. And so that slows down your compounding a little bit. So ideally you would want a company that could reinvest the whole thing And some of this you can get at with screens. I mean, you can screen for companies that have generated, high returns on capital, high returns on assets and over a 10-year period of time. And you can start to dig your way through those names. And a lot of them are going to be names that, are great businesses. The other thing is, I mean, if you're really looking for 100 baggers, is to stay on the smaller side. I mean, Apple is still a great business today, but not going to be a 100 bagger. I think we can safely say. So some of it is you can help with screen. Otherwise, this kind of reminds me of the question I get a lot is like, well, where do you get ideas? And, it's sort of changed over time because I've been doing this a long time. I now have a watch list of a lot of names that I keep track of. And you just do a lot of different reading. You can get tips from other investors. Somebody finds something they're excited about. Maybe you take a look at it. Yeah, I mean, there's really no magic trick to it. I wish there were. I wish I could say, you plug in these four or five numbers and you do a screen and you're going to get a list of 30 names and have at it. But it's just, it's not that simple.
I think you could make a great product out of that, like the magic formula or something like that.
Right. Magic formula is not a terrible screen. I mean, that's a start. You just need some way to filter out. You need some way to filter stocks. I mean, another filter that I like is just insider ownership. So, if I look for insider ownership at least 15% or something, it chops out a whole bunch of names. Now, am I missing some really good companies by doing that? Of course. But you have to find ways to filter somehow. And I like investing with companies that have high insider ownership. And I think it brings the alignment with shareholders closer together. And, there are many examples of 100 baggers where you had a strong insider presence. Not all, of course, there's lots of exceptions, but it's also kind of a matter of taste,
Also, screening is like a good idea of screening is to look what other good people do, what all of us do, to look what this fund has in its portfolio.
That's right. I mean, that you make a good point because, nowadays is probably the easiest time in the history of investing to find ideas. I mean, there's just so much. I mean, just in the amount of, hedge funds and mutual funds that publish quarterly letters, there's tons of ideas there for you to look at if you wanted to just read there, and you're looking for certain things, so you just kind of look and you get a lot of ideas that way. With all the computer screening process that we have, I mean, there's just a tons of ways to get ideas.
I have the question, what makes you kill these ideas? But I also have another question. Maybe we answer both, but let's start with a question from the chat, because you have also people have also your blog, or they see your blog, and it's a good way to screen for ideas as well, because you've written a lot of interesting content. You can find the link to the blog under this video, so you can easily find it. And thanks that you also made an RSS. I ask you for that, and it's great, so it can be easier. And the question is, like, if you look back in your good work you're doing there, are there currently maybe 2 or 3 names that we should look again now, or you're looking again now, or you think, if I ask this question, I can look at that again now?
Ideas to look at now. Well, I mean, we've had such a bounce. Well, I'm tempted to think about things that are really unpopular, but that I think are good assets. So I don't know when's the last time I wrote about Intercontinental Hotel, for example, but that's one that's interesting, and not just Intercontinental, but also, Marriott and Hilton, those big 3, they're similar. There are some differences between them, kind of what you favor. But what's remarkable about them is they're asset light, mostly franchise businesses. So even during this time, which is the worst time you could possibly imagine for hotels, they really have had the worst year, going back, I don't know how long you got to go back to find numbers as bad as they're putting up this summer. But they're still going to produce free cash flow this year. So it's a real kind of proves out how their model. I think the stocks are all pretty cheap when you consider what they could earn, back in a more normal environment, say take 2 years, say it takes 2 years. So that's one that's interesting because if you look back, they've consistently generated very high returns on their capital. They're, in fact, Intercontinental, if you look back over the last 10 years, the amount of capital invested in the business has shrunk, and they've generated a lot more free cash flow. So that's kind of the ideal business, where you're getting a lot more free cash today than you were 10 years ago, and then actually doing it with a lot less capital. So that's one interesting idea. Well, there's other things that I've written about that I'm not as enthusiastic about anymore, because the world has changed with the COVID and the pandemic. And, I've written about aircraft leasing, for example. I'm no longer in that name. That was one of my best performers last year, but they just have a very, very difficult road. And, if I was going to get involved in aviation, I would probably choose a different way to play it. Maybe, something like HEICO would be a good way to play it. It's a much better business. So anyway, that's a couple of thoughts to mind.
Thank you for the good answer for the question from the chat, and to our audience, you're welcome to ask more questions in the chat window. I already saw 2 other questions. I want to drop them in during our conversation. But I also have a question that's coming, I already asked, and that's coming from one of the people who wrote before our chat, is how you kill ideas.
Yeah.
But there are a lot of ideas out there, and what's your way to decide that's interesting, I invest more time, or just kill the idea?
Yeah, lots of ways to kill ideas. One for me is if it's got a lot of debt. That's easy kill. I don't like the ideas that are really deeply cyclical. So I'm not going to be interested in, say, mining companies, or I'm not going to spend a lot of time looking at tanker stocks, or, these sort of heavy industrial, very cyclical names where you look at their performance over the last 10 years and they're all over the place. That's easy kill. That's easy kill. There are certain industries that probably are easy. I mean, I'm not going to invest in, say, like, little biotech names where they have one or 2 drugs. That's just not, I don't have a skill set in that area. So that's easy to kill. There's a lot of businesses that are not really that good. They're just mediocre. So when you see businesses that, their return on assets is low single digits, the only way they get into a double-digit return on equity is they're using a lot of debt. Businesses that don't really have much of a competitive advantage, where there's lots of competitors and it's nothing particularly special about it. And those businesses are kind of easy to kill. I mean, there aren't that many really good businesses around. And so those ones are easy to kill. If there's any sort of whiff of that there might be some sort of fraud, or any sort of whiff that there's accounting issues, I stay away from those, like overly complicated things. And traditionally, I've been reluctant to get involved with roll-ups where these companies do a lot of acquisitions, but I've changed that recently. As I wrote about in the blog, there are some companies that have been very skilled at acquiring lots of companies. Constellation Software is one that I've written about. I do not own. HEICO, of course, is another skilled acquirer. Brown & Brown, this insurance broker that I own, has proven to be a very good acquirer over a long period of time. So those are some ways to kill ideas.
How important is management to you to kill ideas?
Critically important. And it's become more important over time. I remember when I was a younger investor, I wouldn't worry so much about management. I would feel like, good management teams leave their imprint in the numbers. And if I was also trying to evaluate and put a premium on a good business, that I was sort of double counting in a way. But I've come to think investing more and more is just a people business, and that management is critically important. So for a couple of reasons. One is the capital allocation over time. One of my favorite Buffett quotes is the one where he talks about, a CEO who is on the job for 10 years, and is allocating 10% of the profits. So whatever, it comes to an enormous number that CEO is responsible for allocating that capital. So that's very important and has a big impact on returns. So, and the honesty of management, if there's any question about management, if there's anything in their history that gives you pause, it's just a lot of other companies. I would not mess with it, because the market's always going to test you. So there's always going to be a time where where the stock's going to be down, and there's going to be some questions about it. And if you don't have that confidence, you'll likely get scared out at those opportunities. But if you have the confidence, those are times you can add to it, and that's really where you generate some alpha. So management is definitely very, very important. I spend a lot of time trying to evaluate the track record there and the integrity of the people involved.
One of your fans from Twitter, Foxcastle Holdings, or fans of friends,
yeah,
he has asked a question on a certain form of management, the family management. And the question is about how you deal to evaluate the change of family generations in management.
Well, a lot of times in broader history, those kind of transitions don't really go so well, but there are always exceptions. I mean, I think about John Elkann at Exor, who is so far, I think, shown he's a pretty good capital allocator, pretty good manager, and he was groomed for that role, very young. And so I think that's one way to look at it, is to say, well, has this person been involved in the business when they were very young? What kind of training did they receive? Another one would be, sons of Vincent Bolloré are people who've been in the business a long time and have been trained to run it from very beginning. So it's hard to know that those transitions will go well, and there's always some risk. But I think what you'd want to look for is someone who has been in the business a while, and and talking to people. I mean, if you can meet them, all the better. But talking to other people, what they think of them, what their interactions have been like, you get positive feedback on those things. They give you some comfort. Those people know what they're doing. They're not just someone who fell in that position because of their last name. But families I think, are generally a positive for me when there's a large family ownership in the business, because there's empirical research on this too, that families in general are good stewards of capital because they tend to be less levered and less aggressive. They're more willing to invest long term. They don't not play the quarterly earnings game. Of course, there are always exceptions, but I'm thinking of several of my holdings where there's a family involved and they've been good stewards over a long period of time.
How do you take into account possible conflict of interest between the family and minority shareholders?
Yeah, well, again, that's going to be something you're going to just look at track record. Have they treated investors fairly in the past? The minority investors, have they treated them fairly in the past? If they haven't, then stay away. There's really not necessarily any other easy way to do it. Actions speak louder than words. So how have they treated minority shareholders in the past? That's what you have to think about.
So hello again to our audience. For all the new viewers, you're welcome to hand in questions. And for all the other viewers and also the new viewers, I'm welcoming your likes for this interview so that many people can see it. Thank you. There's one question that I found quite interesting, and I haven't thought that this kind of question might be handed in. What sectors or specific stocks will benefit most from a Biden victory in your eyes?
Yeah, that's an interesting question. I've thought about it a little myself, but I don't I don't think if you're really going to be a long-term investor that you should necessarily worry too much about, the outcome of who's going to be president, because even if Biden is president and you have an investment, hopefully, if you're right, it'll be one that you own past his presidency. So I wouldn't let those influence you too much. I know there'll be a lot written about that as we get closer to the election. People will come up with their, Biden portfolio and their Trump portfolio, but I don't really think of it that way, unless there was something that would be like an obvious target, like maybe, I don't know, I'm trying to think of an example where you might be particularly scared. I mean, if a politician had it out for a particular industry and you might be a little more cautious, but I think, I don't know for sure, but depending on how the U.S. election goes, you're still probably going to have divided government. And it's not so easy for one person to just, do what they want. And so I'm not that concerned about whether Biden or Trump wins. I don't think, if you told me who the next president was going to be, and I would know for sure, I don't think I would change anything in my portfolio as a result. I'm sure I wouldn't.
There's also one question coming from the chat from a friend of you from Argentina. It's Diego Martinez Bursaco. I hope I spell it right. And he's asking about where do you currently see more value, like in the US or in emerging markets?
Well, I used to, especially when I was writing newsletters, I used to do a lot more in emerging markets. So I don't really do that as much anymore. So I don't have a strong opinion on the emerging markets. I mean, I think there's always value in every market, but the question is, sometimes there are cheap stocks that are cheap for a reason. Of course, there's lots of cheap, say in the US, if you're looking at cheap stocks, you might look at, there's a number of energy companies or something, but maybe there's not exactly the kind of businesses you want to own. I mean, I think there's some pretty good value in certain patches in Europe. But again, this is not necessarily a question I would think about that way, because, where a company's listed, of course, doesn't necessarily mean that's where they do business. So I mentioned Intercontinental Hotels listed in London. It's also listed in the US, but they have a big business all over the world, US, Europe, Asia. I could think of another example, like Air Lease is listed in the US, but 95% of their business was outside the US. So is that really an American company? I mean, more than 20% of their business was in Asia. So I don't really look at it that way anymore. Like, I don't think of it in terms of this market is cheap. I try to focus more on the individual companies, and you have to, of course, consider where they're operating. So a company that is trading at 10 times earnings in a tough market might not be so much cheaper than a company is trading 20% in an easier market. So I just don't think about it in terms of geographies that much. So I don't have as helpful opinion there as I might have one time.
A question from the chat or annotation by Jens was about dividends and their role for 100 baggers. Maybe you can say something about these 2 points, dividends and 100 baggers.
Yeah, so this is sometimes a hard point for people to swallow, because I'll say with 100 baggers that dividends are not important. And then ideally, again, you would have a company that doesn't pay a dividend at all. And people sometimes will chafe at that because, of course, there's lots of research that shows that dividends make up a substantial part of equities returns, and people like getting that dividend check. But as all I'll say is, if you're looking for 100 baggers, you really need to have the full effect, maximum compounding. And the way to get there is to have a company that can take all of its profits and reinvest it in the business and earn that high return and do it again and again. If it has to take its profits and has to pay out a piece to its shareholders, well, just intuitively, you have that much less to reinvest, and it slows down your compounding. So again, this is ideal. In the real world, it's hard to find companies that can reinvest all their cash flows. And most companies will pay some dividend, or they do some buybacks, or there's other ways that, there are other uses for cash. So, but dividends shouldn't be a consideration. And Thomas Phelps said that as well in his book. I believe he called it an expensive luxury. He said a dividend was an expensive luxury because if you sought dividends, you were kind of intentionally slowing down your own compounding of capital over time. So, I would say, don't worry about the dividend. Instead, focus on the cash flows and then how they reinvest and allocate those cash flows. Sometimes, a business really is super capital light, requires very little capital, and then they pay out dividends. That's fine. I mentioned Intercontinental Hotel before. That's a business that is, if you look at it, a 10-year history, it's paid out quite a bit of its cash flow in dividends and special dividends because, again, they don't need the capital. It's a business that can grow with minimal capital, which is kind of the holy grail if you can find business like that.
In one of your former interviews, you mentioned that the importance of networking, events, getting connected to other people to find good ways to find uncommon ideas that might turn out as 100 beggars. Now we are living in a different world somehow.
Yeah.
What are your ways to track different ways to finding ideas in the last months or weeks?
Yeah. So I am a person who loves to go to conferences. Berkshire Hathaway was a big networking event. Berkshire Hathaway's annual meeting in Omaha was a big networking event I go to every year. Of course, couldn't do that this year. I often make the trek to Toronto as well to go to the Fairfax's annual meeting for similar reasons, not only because of the Fairfax meeting, but there's a lot of other things going on around that time, and there are people who come in town for that maybe I only see there. The same is true in Omaha. And then, there are other financial conferences that come on here and there that I would like to go to, but, all that stopped. So, it depends. I find value in those kind of networks because I enjoy meeting and speaking with other investors about ideas and what we're seeing and what we're doing. So, there's also one of my favorites is MOI Global, and a lot of that's online. So we're still able to do that. And all the people that I've met over the years at these different events, we still talk and swap emails and call occasionally. So it's easier to stay connected with other investors than ever before, I think.
So you do a lot of phone calls.
Yeah. I mean, definitely on the phone. One of the ironic things too is I'm not doing as much travel. Well, I'm not doing any travel this last few months, but I have probably talked to more management teams than I ever did before. And part of it is because they're also they have much less to do and less travel and more time to talk to people. So it's maybe one of the silver linings of this whole process.
So it's easier to get an appointment.
Definitely. It's easy. I've found it's been much easier to talk to people now than before.
Have you used these days also to think about portfolio composition, how you size positions, how you allocate? Which
Definitely.
is your way to do this, and how has it changed maybe in the last weeks?
Well, I would say, the pandemic definitely made me rethink positions because I had walked into this with a lot of exposure to travel and aviation and some other positions that were directly affected by the pandemic, either because they had to shut down or whatever. So there was a lot more turnover in my portfolio than I would have liked. But I have to, this is a new risk now to underwrite. As I tell people, now we have something new to think about. So before, when I would underwrite a company, I always look back to 2008, see, well, how did this business do in 2008? How did it hold up? And now it's also going to be, well, what happened during the pandemic? And as building that portfolio, you're going to have to build a portfolio that can weather a pandemic. So again, you can take some risk on a pandemic. Of course, I'm going to, if you're going to own a hotel or a restaurant, but you're just going to pay attention to how those positions connect. And pandemic, I like to say it like it connected the dots to a number of my positions, connected a number of my positions together in a way I wouldn't have thought before. So that forced a change. As a result of this too, though, I've become a little more concentrated. I think early part of the year I had like 15 positions, and now I'm down to 10. So a lot of that has been selling one thing and rolling the proceeds into other things I like better. So the way I think about portfolio construction now is ideally I would have maybe 10 to 12 names, somewhere between 8 and 10% each on cost. And so it's pretty balanced. I don't think I'm not a big fan of trying to overweight positions, or people say, well, this position is riskier, so I'm going to make it a smaller position. For me, I just want to have it all balanced, because at least for me, what I've found is that there isn't that much difference in return. In other words, if I were to give you my top 10 names, it's not necessarily that number one is going to beat number two, is going to beat number three. Sometimes number 6 is the best one, and you're just not sure where the performance is going to come from. And so I've found it's better to just kind of keep it more balanced. And the other thing that I try to do is I have a limit for how much I'll put in any one name on a cost basis. So for me, it's no more than 10% of the portfolio in any one position on a cost basis. So that's there just to protect me against myself. I mean, every investor gets enthusiastic about a name, and then, it doesn't work out. So you don't want to have that happen when you love a name and you've got 25, 30% in it, and it doesn't work. And that now you're really in trouble. So I'm okay if it appreciates, much larger. I think in my fund, the limit is 20% on any position. So, and it's actually tough to get there if you work out the math. Even if you put 10% in one name, it has to double, and everything else has to go nowhere, which is really not usually how it happens. So that's how I think about portfolio construction. That and again, keeping in mind trying to keep a balance of risks. So if I have one hotel stock, I'm just going to have one. I'm not going to own another. If I have one oil name, I'm just going to have one oil name. I'm going to have one. I don't want to have too many connected positions.
There's one question related to the 100-bagger mentality about cutting your winners. When do you do it, or do you even do it?
Like rebalancing winners and yeah, that's a good question. So, I mean, this is where an individual investor might have an advantage, because they can allow a position to really become big. As a professional investor running a fund, you can't. I guess some people do, but it'd be very risky to allow one position to become half your portfolio, let's say. But really, this is a matter of personal preference. And if you really find one that's a winner and you have to cut back on it, yeah, that's a good problem to have. But ideally, I think you just let it ride, as long as everything is in place. Now, I remember reading, like, for example, I've talked to Chuck Opry. He's had 2 100-baggers, Berkshire Hathaway and American Tower. And I've talked to other money managers who've had big winners like that. I know there was one money manager I know who's retired now, but he had Walmart. And he says it was just every quarter he was selling it. It's because, it hit his limit.
Are you still
and
there?
Every quarter was performing. He's just constantly selling. So, yeah, I would say, that's a personal preference. Let it ride as long as possible. Just don't touch it and let it go.
There's a question from the chat from Frank Wang. What are you excited about currently? And what companies or sectors have maybe made a positive surprise for you?
Well, I mean, there hasn't been a lot that's been like too much of a positive surprise this year. It's been pretty tough. What I'm excited about is, I mean, there are several companies that There are a couple I don't want to mention yet because they're maybe a little small. And but let's say in general, the kinds of companies I'm talking about, I've found a handful of names where I have really good owners. I've got long runways where they're going to compound at least double digits. And so I'm really excited just to follow their stories. I don't think there's any particular sector that I would point to as being particularly interesting. I mean, yeah. So anyway, I don't want to give any of those couple specific names just now, but I don't think of it necessarily on a sector basis. I think there's some really good businesses I'm excited to own, and we'll see how their story plays out. Maybe I'll write about them on the blog here soon.
Then maybe let me try to reframe those questions. What were positive surprises for you in this year as an investor?
Well, I think some of the positive surprises would be the resilience of some of these businesses in this environment have been encouraging. So when I look at, I have a pizza delivery business stock has held up pretty well this year. So it's very adaptable to the pandemic. So my insurance brokerage firm, Brown & Brown, has held up pretty well year to date. So there's a couple of companies I have that are involved in necessary industries that were allowed to operate. And, they've been positive surprises. They've held up much better than the market. And I think that's one interesting takeaway from this whole pandemic process is to see which businesses were able to survive this and continue to operate and prosper during this. And that's kind of like the ultimate test of durability and resiliency. So I really have a high degree of confidence in those businesses going forward.
And maybe to see the other side of the coin, what were negative surprises? Maybe also nobody's talking about, but you experienced in the field of investing.
Well, negative surprises, I think, would be the length of these shutdowns. I think if you had told me in March that there would still be a lot of businesses closed here at the end of June, I wouldn't have believed you. So that's definitely been a big negative. And even in the U.S., some of the states that have opened up are now rolling back or closing businesses again. So that's definitely a negative. And I'd say a little bit of a surprise. I think maybe another surprise has been the resistance of people to do the social distancing and wear masks. It's kind of a surprise. Maybe I shouldn't have been surprised, but it's made it more difficult to beat the virus here in the U.S. We're at new all-time high in cases, so it's going to be difficult to roll that back if people don't play ball. So it's been some negative surprises.
Interesting to hear the points. It's also kind of intense debate about mask in Germany, but I think most people are following the rules, and it's not this kind of intense politicized debate as you have in the United States. And I hope there's a turning point to that, because it's really helps to wear masks in public spaces.
Yeah,
especially if you have a high virus load.
Right. Yeah.
Maybe let's get to one question from the chat. It's from William Walsh, and he liked your piece on visible moat last week. It was great. You mentioned
Thank you.
ODFL. They compete with a roll-up, which you mentioned you recently changed your opinion on, XPO. Are strong network effects needed for roll-ups to work? And he's also asking, how do you evaluate roll-ups, judge acquisitions?
Yeah. Well, there's a very simple way, not a very simple way, but there's one way where I look at roll-ups, and that is, if hopefully you have a long history. So I've done this before, where you take a company, you look at the last 10 years and you see how much they've put towards acquisitions. And then you see what the return has been on those acquisitions. So a simple way to do it to start is, you could say over a 10-year period, company spent however much on CapEx, and however much on acquisitions. And then you can also see free cash flow per share return. Free cash flow went up however much percent. You can see the changes. So you try to get a sense for what their return has been on those acquisitions. And the other way is if a company is earning a pretty stable return on invested capital over that time, or look at some return metrics, ROA, ROE, ROIC, those kinds of things. And if they're pretty stable, that means they're doing a pretty good job. That means they're acquiring these companies and they're folding them in, and they're keeping their same high level of financial performance. So that's one. The other way is to track impairments. I mentioned Brown & Brown. I believe Brown & Brown has never had an impairment on an acquisition. So that also tells you that they're probably doing a good job. A company that's constantly writing down, does acquisitions, and 3 or 4 years later, they're writing them down. It's a company that's probably not doing a good job on acquisitions. Likewise, if you have a company that's doing a lot of acquisitions and over time you see slow degradation in returns on capital, that would also be a sign that they aren't doing such a good job. Maybe they're showing great growth in earnings, maybe they're showing great growth in sales, but if their return numbers start to degrade, that's a warning sign that they're not creating value.
Thanks for this answer. I also want to welcome all our new viewers, and if you like what we are talking about here, please leave a like so that the video can be seen by many people. And I want to say hello to Dennis Hong, who's also soon on the live stream. And he has 2 questions. What is your long-term vision for Woodlock House Family Capital? And what do you feel is your edge as a professional investor?
So what's my long-term vision? Well, my long-term vision would be that really I don't need any additional capital. The capital I have, I just compound that at a good rate over a very long period of time. Owning a concentrated portfolio that does not turn over much, that would kind of be the ideal. And that would be what I would hope to look to achieve. What was the second question?
What is your edge as a professional investor?
My edge. Oh yeah. The edge is always an interesting question. I think a lot of people talk about edge and they don't really have an edge. So, it's difficult to really have an edge analytically, I think, because we're all doing the same sort of stuff. We're looking at the same numbers. I guess perhaps there are firms out there that have an analytical edge where they are going well beyond normal due diligence, but I think that's a hard way to build an edge. I think the best edges are more built around soft skills, like more around behavioral things. So being patient, that might be the real last edge, because there's so much trading and algorithms and all these things. You're not going to compete with those on a short-term basis. So your edge, this is true for individual investors too. Your best edge may be your ability to look out more than the next couple of years and plant your flags that way. So I think one edge of mine is around the behavioral things. I think I'm very good at holding positions, patient. I think there are some basic things that I really focus on that I think maybe other investors don't pay as much attention to. So for me, it's all about the incentives, getting the incentives right. I spend a lot of time looking at the management teams of my companies and how they're incentivized, whether they own a lot of stock or what their incentive comp is. It always makes me think of Charlie Munger's famous quote where he talks about, show me the incentives, I'll show you the outcome. And so that's an important piece for me as well. So, the other thing I like to say is that I wrote newsletters for 15 years. I have a very good network of people, both in the investment world itself, but also in industry. I mean, if there's an industry or business I want to learn about, odds are I can find somebody who knows something about it. And I think that's a nice advantage to have.
I have also a question from Stephen, who sent it in before. What do you feel is not emphasized enough in investing?
Well, I think I'm going to flip that around a little. I think there's one thing that's emphasized too much, and that is, I think there's far too much emphasis on the market as a whole, what the market might do, what the economy might do, and most investors, even professional investors, I think will spend too much time thinking about those kinds of things, sort of unknowables. And I think you're better off focusing on the smaller things that you can know, like really understand the economics of a business, what makes it tick, how does it really create value? Why does it exist at all? And so that's not emphasized enough. There's another thing sometimes I like to say, which is that, which people forget, is that, the stock market is a market of secondhand goods. So the only, reason you're able to buy a share in a company is because somebody else didn't want it. And so when you think about it that way, not only did somebody else not want it, but the original owner didn't want it anymore. The guy who started it. Why is that? I think if you come at it with the mentality that, there's always someone on the other side of the trade, gives you some pause to think about it before you buy. Make sure you have a good thesis and why you're buying, why someone might be selling it to you, and what the counter thesis is to your thesis, and you understand it. I think those things are really helpful, and they're not really talked about very much.
That's also a good pitch to build up for the next question. It's how you're building positions. Do you like tranches? Do you buy over time? Or how do you build positions, and when do you make exceptions to your way of doing it? If you make any exceptions.
Yes, definitely. So normally I would like to buy it in a little bit like tranches. So for me, if a full position is something around 8 or 9 or 10, say like eight between 8 and 9, then I might start something around 3 or 4, and then kind of quickly get it to 3 or 4, and then maybe wait, and then work to build that position up over the next coming months. But usually have a full position on certainly before a year is up. And to make exceptions for that, definitely. And the one where I would make an exception was when we had something like we did in March. So when you have market just fall out of bed and you have a big stiff drop like that, you might go ahead and just say, well, this instant, I'm going to go ahead and buy it all pretty quickly. So that's the exception. I can think there's been times when that's happened, when we've had big corrections in the market, and where you're going to say, okay, well, I'm just going to buy this, and you're not going to tranche it. But in general, I prefer to do it in tranches, because also, no matter how much research you do and how much work you do on a name, there's some more things you learn about it owning it. There's something psychological about it. I don't know, but it's like your level of attention kicks up another notch when you own it. And that's why I know some money managers who just like to even take very small positions, maybe 1 or 2%, just because they know that now they own it, it raises their awareness to another level, and they work harder on it than if they didn't own it. So everyone's different. You have to think what works for you. But for me, I don't really like to keep little positions around. When I have a position that's like 3%, I have to hold myself back because I want to make it meaningful. I want to make it big.
Position, yeah.
I want to make it big, or I just want to either or that, or get it off, or get it out. So that's just the way how I think about it.
What are examples for what has changed when you had a position in a company? Like what new came out of this magic of having a position?
Well, for me, I don't know. Yeah, for me personally, I don't know if there's anything that comes out of it specifically. I just think it's more of a general sense. Like, so you start to, pay attention in a different way on earnings calls, and you start to, when management's speaking at conferences and news stories come up, you just, I don't know there's any necessarily magic to it, but it just feels like once you've owned something for a little while, you've gotten used to it. You've even seen it, how it trades, and you're just used to it, and you're more comfortable with it after you've owned it for a little while. I don't know how to explain it other than that. It's a weird psychological thing, I guess. But at least I find it's true most of the time. You own something, you get a little more familiar with it than if you just didn't own it and you just followed it more distantly.
After buying and hopefully having 100 bagger, the process of selling comes in. How you go about selling and what's your approach to it?
Well, I have to say selling is the hardest thing in investing, because if you're doing a good job, you're almost always going to sell something and you're going to see it just goes higher, it's higher a year or two later, and that always drives you crazy. But if you're really buying good assets and good businesses, that's going to happen. It's easier to sell with, well, not easier, but when something goes wrong, company starts to go off the rails. Maybe they did an acquisition you think totally you disagree with, and you sell it. For me, I prefer to go out quick. I did partial sales, but I'm never really happy with that, because for me, I'm either in or I'm out. And I don't like to, something goes up, then take half of it and just let the rest ride. I don't really like to do that. So for me, most of the time when I decide I don't want to be in something, and I just sell it all pretty quickly.
Markets can be somehow brutal. So you have sometimes phases where things just go nowhere and then explode. So, and if you have confidence in the company, how do you keep to that company even if there's nothing happening?
Yeah, I'd say that happens most of the time. I mean, most of the time it seems like sort of nothing happens, and then you have this big move, 30, 40% move in months, and then it's sort of not much happens again. And well, for me, it's very hard, but you have to not let your emotions get tied up in the stock prices. So you can't feel good because it's up, and you can't feel bad because it's down. And you just have to focus on that, on the business. And you really don't have that much to look at, because you're going to get a report every quarter or every half year. If a lot of these European companies only report half-year results. So then you don't let the trading influence you. I don't know how to really say it other than that. I mean, it's almost you just have to train yourself not to get down when the stock price is down.
Do you have any ritual or something you do before you want to press the sell button?
Yeah, sometimes I always feel a little sick when I sell something, because it just feels like, that just always feels like, there's this little voice like, are you making a mistake? And it's never fun to sell anything, in my opinion. It's rare that I've sold something with great authority and been like, yes, this is the right time to sell. There's always some doubt. And you've done a lot of work with it. For me to sell something, usually I've done a lot of work on the name already. Probably for me, I've owned it for a while. And so it makes it harder to sell. But I would say, no, there's no ritual to it. Just you just sweat bullets and sell, and life goes on. You can have to focus on what's ahead, what you have, not what you've necessarily sold. I know sometimes it's also tempting to keep track of all your sales, which I do, and then review them, and you can see kind of how your decisions played out, and you get a sense about how you are when your buys and your sells. Sometimes some people say they're always a little early or they're always a little late, and you can get a sense for how you are.
Maybe there's a practice to it, like yourself a lot in this case. And we are here to question you. So further questions are welcome. This is the last call for questions. So if you have any, drop them in the chat. They are free waiting for you. And Nishan is asking, what's your take on high growth SRS, on the high growth SRS sector?
High growth. What sector?
Software as a service.
Oh, software as a service.
Yeah.
Well, I mean, I think those things can be great businesses, and I don't own anything in that sector right now, so I don't know that my opinion's worth much there. But I mean, obviously it's great business. It's just always a matter for me of, what's the valuation? How much can you pay?
Okay, that's a clear answer. I have another question from Dennis. He is asking, what's your advice for young people who want to get into the investment business?
Yeah. To get in the investment business.
Mm-hmm.
Well, I think now, because there's so many different ways to get ideas out there, you could create a website or a blog, or get on something like a Seeking Alpha, and you can start to share investment research that you do. That's always a good way to get in, because you can distinguish yourself with your analysis and over time, and maybe you'll get picked up somewhere. Maybe somebody will be interested. I've known people who've gotten positions that way, and they've picked up work at hedge funds, even if just part-time analyst position or something. That's a way to get in, and that's one good thing about the world we live in now, is it's so easy to publish and share ideas, and there's so many platforms. So that's the best way. You just get out there and just do it. Start doing it, start trying to share ideas, start trying to improve, get, feedback and criticism on your ideas. I've had people send me write-ups and say, love you to just read this and give me your feedback, and I'll read their write-ups and give them feedback, and hopefully, it helps them improve as an investor going forward.
There's another question from Tyler. How long is your research process, and how was that been affected by the COVID crash?
Yeah, it sort of depends. Some companies are simpler than others, and they don't require as much work, and some are more complicated. Like, if you're doing a real estate company and you want to visit some of their major properties, that's going to take a while. So I'd say the research process really depends. If it's a simpler company, you might be able to, my research process then, I'm thinking, might be a matter of weeks before I get comfortable enough where I can start to buy something. But if the position's more complicated, or if it's in an industry that I'm not as familiar with, then it might be months. And of course, that's not the only thing I'm working on, but it might be a while before I really ever get comfortable. I may never get comfortable. And then how is it affected during this crisis? Well, the biggest thing is I'm not done any traveling. So I haven't done any company visits, haven't met with anyone face to face. And that's been a hindrance, but not as great a hindrance. So for example, one of the companies I bought in March was Copart, and they actually have a YouTube channel. You can go there, and they have tours of their different yards. I think I toured like half a dozen different yards all over the place. And so you get a good sense for what their places look like, what they feel like. People work there. Even customers will put up videos. They're going through Copart yards looking to buy certain cars. I got a kick out of watching a number of those. So you get both perspectives. You get the company showing off its yards, and then you get the customer perspective actually using it. So in that case, it was remarkable. I was able to do quite a bit, even more than I would have, because I don't know that I would have necessarily found that before. So I was able to do quite a bit just using the computer and, online, YouTube. So it really depends.
That's an interesting story to hear. Like, if you look ahead 5 or 10 years and from now, and think about interesting hunting grounds for stalks and maybe 100 beggars, which fields come into your head?
Well, my first thought, listening to your question, is that it doesn't really matter that much about the industry or the sector, because when I did that 100 bagger research, that was one of the things that surprised me, was the number of sort of just prosaic businesses that you wouldn't necessarily expect are on there. So there were a number of, oil and gas businesses. There were number of simple businesses, and it wasn't like they were dominated by, tech names. Like there was all, Microsoft and Amazon, Intel, or whatever. It was quite a mix, So I wouldn't worry too much about sector. I think people maybe put too much emphasis on that. They want to know like what sector is most attractive. But if you just focus on the basic economics of the business itself, it can be in a variety of sectors. I mean, I wrote up, Old Dominion, ODFL on the blog, and it's a trucking business. Who would think that a trucking business could be such a wonderful compounder? I mean, things done 20, 30% for years and years and years. So that's because they have a good model and they have a good culture there, good ownership group, and they've managed to carve this niche out. So, if I would have sat here and said, well, you should look at the trucking industry. No, I would never have said that, So I think I don't worry too much about sector. There's good businesses in there, and sometimes they do very simple things. Look at Domino's Pizza. It's been a fantastic stock. I think I saw something where I forget if it was Domino's and Google or something. I think they went public around the same time. Tillman, you may remember. I don't know, but Domino's Pizza has actually outperformed. It's so crazy, right? Who would have guessed that? But that's because the economics of that is so wonderful.
To come to the end of our interview, which was fun, and it was great to have all your questions. So thank you very much to the audience for all the good questions I was able to ask. Do you have something to add we haven't covered and it's maybe interesting that comes into your mind? And maybe to bring back the bookshelf, if you've maybe came up with another idea for an interesting book you recently read.
Well, yeah, I mean, other book I like to recommend for people is, Peter Lynch's first two books. They're easy reads, and I think, he has In Search of 10 Baggers. He was the one who liked to talk about 10 baggers, and he had a number of big winners. But what I like about those books is how he talks about how he found these different ideas, and a lot, people simplify and say just buy what you know, but he had some interesting insight in there about how he found certain ideas. And still, it's dated because a lot of the examples he chooses are things that aren't even around anymore. But those are good reads. I'd recommend those. They're kind of classics. And I think they're helpful for today. But I think it's been a fun interview, Tillman. It's been good talking to you. And I know I've come across you on Twitter before, so it was good to meet you, sort of, on Zoom. And then now I have a face to connect to your handle.
I hope we meet one day in Omaha, because my plan was going there, and
I
would have loved to meet you, but
I'd love to go to Stuttgart.
You're welcome. We can.
I love Germany. I've been to Germany a couple of times. I've loved it. I love the whole. I like Germany. I like the whole beer garden culture.
Yeah, you can have a lot of good beer here. Pretzels and sausages and stuff.
Yeah, great stuff. Yeah.
You're welcome here.
Thank you.
So thank you very much for the great interview, and thank you to the audience for the great questions, and have a great day or week as well. Thank you.
Thank you.